Hello, Matthew Bell here, and today I just wanted to continue a series on retirement plans. So you'll recall, number one, by retirement plan we mean a vehicle that you are putting money into now in order to save for your retirement later on. Now we've talked about a number of these vehicles. We've talked about employer-sponsored plans like the 401k and the 403b. We've talked about other tax-qualified vehicles like the traditional IRA, the Roth IRA. For those videos, I invite you to click on the links. I'll have them down in the description. We've talked about other topics. So today I wanted to talk about one that is a little bit more arcane, a little bit less common, and that is the 457 plan. Just a couple of caveats to get them out of the way. I am not a financial advisor, I am not a lawyer, I'm not a tax preparer, I cannot give you retirement advice, legal advice, financial advice. This information is for general, informational, or entertainment purposes only, and for specific recommendations and advice you need to contact your plan administrator, your tax preparer, your financial advisor, or other trusted and competent advisor. So the 457 is a more complicated instrument in some ways, in part maybe because it's less common and just seems more complicated because the provisions that govern it are not as widely discussed. But there are actually two different kinds of 457, and just as a reminder, where do the names come from? So 401k, 403b, 457b, and so on. These names come from the Internal Revenue Service, and in particular the Internal Revenue Code. And so if you go to section 401, subsection K, you'll read about the provisions that govern the 401k. If you go to section 403, subsection B, you'll read about the provisions that govern the 403b, and same thing with the 457. Now the 457 actually comes in two different variants, the 457b and the 457F. And sometimes these are referred to as the eligible 457 and the ineligible one. I'm not really going to get into the weeds very deep on this issue except to say that the main difference that I've detected between the 457F and the 457B is the question of whether or not the contributions are really going to be tax deductible and the earnings are going to grow tax deferred. So in the 457F, it may or may not be the case depending on whether or not you have the danger of forfeiting the money in the account. And this is beyond the discussion here. So if you have a 457F, I would say contact your plan administrator. Make sure you sit down with a tax preparer and really dive into the nuts and bolts of that plan. But we're going to talk today about the 457B primarily. So as we're discussing these plans, I would say try and keep in your mind a threefold arrangement. We have contributions, that is money going into these retirement plans. We have earnings, period, where hopefully the instrument is going to be accruing some additional value over what it had previously. And then we have a payout period or a distribution period or a benefit period, which is where you're actually drawing on that money in retirement. Now, just a word on the earnings period. There is no guarantee generally on what type of investment result you're going to get. Now, you may have, in some cases, the ability to invest in a fixed annuity, and perhaps you are guaranteed some kind of a rate of return. But if there's any market implication, if you are invested in any kind of variable product, or if there is a sense in which your return is dependent on the stock market or the bond market or in some way some security or some equity panning out, then there is no guarantee on the amount of money you're going to end up with in your retirement vehicle. Now when I say earnings, then I mean that in principle these vehicles are capable of accruing earnings, and not necessarily that you will experience earnings. It's possible to experience a loss. But the main difference between the 457B and its more famous 401k cousin, if you want to call it, that is the type of company that's going to sponsor these plans. So 401k is generally going to be sponsored by a for-profit company, whereas the 457 is generally going to be sponsored by a government agency. So 457s are often offered by state or local government. Sometimes they are also available to individuals who work at 501c tax-exempt organizations, so nonprofits of some kinds, but often nonprofits will utilize the 403b, and sometimes they'll even utilize a 401k. So the 457b is mostly government, and you don't see as many, and probably that's just in virtue of the number of people who are employed in the government compared to in the private sector. So technically, the 457 is not considered to be governed by the Employee Retirement Income Security Act, or ERISA, that governs other qualified plans. And so the 457B is often, you'll read that it is not technically a qualified plan, but what it is a deferred compensation plan, and it makes it very, very similar to the 401k and 403b in that regard. With respect to the 401k and the 403b, you will read that contributions are sometimes referred to as elective deferrals, and that means that basically money you were going to get as salary or as wages, you elect to defer into your 401k. And in a similar way with a 457, it is a deferred compensation plan, so money that is owed to you as compensation you can elect to defer into this account, and when you do so, generally speaking, again with the 457B, you are not going to pay tax on the money that you contribute in the year that you contribute it, and then it will grow, or at least it can accrue earnings and principal tax deferred, and then you only pay tax when you take distributions on that money in retirement. Now, because it is not governed by ERISA, that's going to change certain things with respect to the accessibility of that money, and we'll kind of sketch a little bit about that here in just a moment. So again, thinking about the contribution, the earning, and the distribution, so we said contributions to that are not going to be countable as part of your gross income. Okay, so they are tax deductible. If you make $100,000 and you defer $6,000 into your 457B, then your adjusted gross income for purposes of tax calculation will be $94,000 in that year, abstracting away from any other deduction you might qualify for and any other relevant piece of information for your tax return. As we said, they're funded by salary deferrals. Contribution limits are an issue that we should definitely discuss, and in that regard, they are very similar to the 401k. So the limitation on the amount of money you can defer into your 457B in a given year is going to be $19,000 if you are 50 years old or younger. If you are younger than 50 years old, if you are 50 or older, you can actually put in an additional $6,000. It's what's called a catch-up provision, and in that respect, you will be able to contribute up to $25,000 in a given year. So this is the same as the 401k and indeed as the 403b in terms of contribution limits. Now, in a 457, sometimes you'll read about a double limit catch-up, and that is unique to the 457, and what that may imply for you is that you might even be able to double up your contribution, meaning to get it all the way up as high as $38,000, I've read in some cases. For the details of whether or not you're eligible for that or whether or not it's a thing with your particular 457, I invite you to contact your plan administrator, your human resource department, confer with your tax preparer, and so on. Now, because these are retirement plans, they are designed to not be touched really until you're in retirement. Now, when you read about 401k or the IRA, traditional IRA, or a Roth, you will typically read about the fact that you cannot withdraw funds generally unless you have attained the age of 59 and a half. Now, because these plans are not governed by ERISA and are not tax qualified the same way, the requirement for accessing the money is a little bit different. So in 457 plans, you may not have a 59 and a half rule technically, and you may not be susceptible to the 10% early withdrawal penalty that is assessed or levied by the IRS the way that you would be if you had a 401k. Now, having said that, there are still accessibility restrictions that apply to 457s, but they're usually phrased differently. So they might be termed, you can't access the money until your normal retirement age, for example. Now that could be variously defined, and it may not be 59 and a half. Or again, you may have an annuity in your 457B, and if you have that, it may be that the 59 and a half rule is relevant to the annuity, even if it's not relevant in the first place to the 457. So these things can get very complicated very quickly, and again, contact your plan administrator, your tax preparer for advice on your specific circumstances. Now, another facet of the fact that these plans are not governed by ERISA in the same way is that they can be a little bit more liberal or a little looser in certain requirements. And one of those is with respect to who can actually participate. So we talked with the 403B. In a 401k, let me start with that. In a 401k, you generally have to be a full-time employee before you can participate. In fact, there may be certain requirements as to how long you have to work for the company before you can start, and then there will be certain vesting requirements after that with respect to the employer's matched portion. Now, with the 403B, it is often available to part-time employees in addition to full-time. The 457 goes a step beyond that. So in some cases, the 457B is available to full-time employees, part-time employees, temporary employees, and even independent contractors. But again, the specifics are going to be known to your plan administrator, and contact your human resource department or your liaison for your plan. And when we say plan administrator, it's well worth pointing out that these plans are either annuities, they are custodial accounts, they're trustee accounts, so they're not the same thing when you have a retirement account. It's not the same thing as if you were going to open up a savings account at the bank. These accounts are placed and started for your benefit, but they are trustee accounts generally, which means that you don't have unrestricted access to the funds and you can't just put in whatever you please. Now that we talked a little bit about the contributions, let's talk a little bit about that intermediate period, the earnings period. And understand that these periods are not just sort of, there's a contribution period and then that stops and then there's an earning period, because it may be that you are contributing every single year. And so the earning period is going to start when, for every contribution you put in, the earning period is going to start for that contribution. So if you're contributing every single year, the earning and contribution periods are going to overlap each other. But generally speaking, earnings are also excludable from gross income, which means you get a tax deferral on whatever money accrues as gain inside that account. And then you are not taxed on that. It's not like if you put in $6,000 into your 457B in a given year and you earn $400, you're not going to get a 1099 at the end of the year for that. It's going to be tax deferred. That earning is going to be deferred. Doesn't mean you don't pay tax at all. It just means that if you get a deduction on your contribution and a tax deferral on your earnings, then you're going to pay tax on both of those things when you're in retirement. Now let's talk about that. So retirement, again, generally in other plan types, 401k, IRA, you will read about the 59.5 requirement, that you have to be 59.5 before you may start taking your money out. With the 457, that might be retooled to normal requirement age, whatever that is. But you may be susceptible to some restrictions prior to that. You might not be able to touch the money and so on. Now there are certain exceptions where people can touch the money a little earlier. For example, if the plan owner dies, is permanently disabled, those are two common ones. But in the 457, they also usually allow for you to be able to access it in the case of an unforeseeable emergency. Now that can be variously defined. It could be a fire, a flood, an earthquake. In other words, property damage, some kind of a casualty or a loss on your property. It could be because of some kind of an accident or illness or injury of some unspecified nature that afflicts you bodily. So in other words, a financial hardship. There could be a number of things that might be qualifying events for an exception to be able to access your money before normal retirement age, but you would need to consult with your plan administrator and your tax preparer. Now another case in which you may be able to access money earlier than normal retirement age is in the case of a rollover. So in technical fashion, a rollover is a distribution, but it's a kind of a distribution where you never touch the money generally. If it is a trustee-to-trustee transfer, for example, you wouldn't ever actually touch the money. Now there are other ways of doing movements of money of this kind. This is not the place to go into them in depth, but suffice it to say that if you, let's say you came from an employer, and severance of service is sometimes an event that allows you to access some of the money in your 457. So if you sever service with a government employer, you are able usually to roll over the money in your 457 into some other retirement vehicle, whether it be a traditional IRA or a 401k. Now, contrary-wise, if you start working for a government employer, maybe coming from the private sector, you are in principle able to roll over the funds from a 401k or a traditional IRA into your 457. But you should be aware that because the rules governing those plan types are different, and they're governed by different laws and different sections of the Internal Revenue Code, you should be aware that rolling funds over may change the way you can access those funds. If you were used to the rules for the 401k and you put them into a 457, you're now going to be bound by 457 rules, and vice versa. So again, and I don't want to sound like a broken record, but I don't want you to interpret any of what I'm saying as direct advice. These are simply research leads, if you want to call them that, and for anything more you need to seek professional advice. Now 401ks often have the ability to take loans against them. Whether or not you can do that in a 457 is going to depend. What I've found in reading is often a government 457 will allow for a loan, but maybe a tax-exempt organization's 457 does not. So again, this is going to be specific to your plan type. Now, just because you can take a loan doesn't necessarily mean you should. If this money is earmarked for your retirement, you might want to think long and hard about tampering with it, because it's going to upset your retirement plan. But in addition to that, there's a cost that's sometimes beyond whatever tax you might pay, whatever penalty you might pay, whatever interest you might pay, and that is what's called an opportunity cost. So whether you're withdrawing funds or loaning against the funds, an opportunity cost basically means that you are going to lose out on the money-making ability of your money. So if you pull money out of an account, pull $1,000, let's say, out, then not only are you touching the 1,000, but you're losing out on the money that 1,000 could make you in a given year. Maybe it's $100, maybe it's 50, maybe it's nothing, but that's called opportunity cost. Now, just as a rehearsal, since you're putting money in a tax deductible way and earnings grow tax deferred, you pay everything tax-wise in the distribution period in retirement, which means that if you have not started to take distributions by the age of 70 and a half, the Internal Revenue Service starts to make you take distributions, and they call that a required minimum distribution, or an RMD. And the idea there is that this money is supposed to be for your retirement. It's not supposed to be held in these accounts indefinitely, and if you haven't started to take the money by 70 and a half, then the Internal Revenue Service starts to force feed it to you, and the idea there is that you're going to start to settle up on some of that tax, even if it's at a slow pace. Now, if you are susceptible to an RMD and you do not take one, there's a very hefty 50% penalty on the amount you should have taken but did not. So you want to make sure you stay up on whatever your RMD requirements are, and you want to make sure you follow those instructions. Now, there may be other things you can do with the money. You cannot roll money over in order to avoid an RMD, but you can't just take the money and kick the tax can down the road. Generally, there is something called a qualified longevity annuity contract that does enable you to reduce your RMD burden. But you also should be aware that there may be other vehicles you can take that money and funnel it into in order to have it do a little bit more work for you, particularly if you've been putting off withdrawing from your 457B because you don't need that money. It may be a good idea to look into what your options are in terms of what you can do with that RMD money. Now, once you take a distribution, whether it's a regular distribution that you're just living off of, or whether or not you're taking a required minimum distribution, or perhaps you have annuitized it and you're taking payments, you're going to be taxed at regular income rates. So if you're taking, let's say, a distribution, an RMD, whatever it is, you're going to get a 1099, and then you're going to take that 1099 to your tax preparer. They're going to add that number onto your gross income, and you're going to be taxed at whatever your normal income tax rate is for that year. Now, it's interesting that with respect to the 401k and the 403b, it was possible to contribute to both, but that $19,000 contribution limit, or $25,000 if you qualified for the catch-up provision, applied to both those accounts jointly. So if you have a 401k and a 403b, you can put in $19,000 to both, but you can't put it in individually. So if you put in if you put in 9 into your 401k, you only have 10 to put into the 403b, and vice versa. With the 457, it appears to be different. With the 457, it appears that if you have a 401k and a 457, in principle, you could fully fund both without running into any difficulty with respect to the upper limit. You could put $19,000 into both of them, but again, double check with your administrator on that. So just as a summary, there are many similarities between the 457B and its 401k cousin. The primary one being that you access these through your employer. It's a different kind of employer, but once you have the plan, the contributions are tax deductible, the earnings grow tax deferred, and then you pay tax on the distributions when you're in retirement. Both are subject to RMDs. I've gotten more into required minimum distributions in another video. As I've said previously, I have an entire video on the 401k. If you have a 457 plan, I think it would be a good idea to familiarize yourself with the 401k anyway, because they are similar in some regard. If you found something of value in this video, I would just ask that you like the video, subscribe to the channel. It does help with the ratings on YouTube, and it enables me to create additional content. My interest in these matters is multiple, but one that I've told the story elsewhere is that my dad died in 2016 of Alzheimer's dementia, and in order to care for him, my mom had to go through, and my dad, but had to go through a Medicaid spend down. And that put my mom's retirement in a shambles, basically. And so, yes, she looks to me to help her recover from this problem. And I look ahead to my own retirement and realized that the plans that I had were not very good or not very well laid. And then as I try and impress upon my kids, who are still teenagers, the importance of retirement planning, I realized that there were a number of things that I was deficient in my understanding. And so in an effort to try and remedy that, I have begun these research projects, and I would say that in virtue of that, my aim here is to share what I've learned and to try and encourage other people to look into their own retirement plans, because ultimately, and I talk about this in the video on the three-legged stool, ultimately in the past, it was the employer pension, Social Security, and private retirement savings might make up your retirement plan. But in 2019, as I record this, with employer pensions almost a thing of the past, and Social Security, according to some people, on very shaky ground, that leaves only your own personal retirement savings. And so you better know what you're doing. At least you better have a plan, and you try and educate yourself as best you can. I am trying to share my investigations with you guys in the hopes that somebody can benefit. I know for me, again, my mom, in the situation we were in, there's a steep learning curve. To try and familiarize yourself with some of these things can be a bit daunting, and I confess it for myself, because it was not, I don't have a finance degree, it wasn't my background, and so in trying to figure out what these plans are about and to plan for my own retirement and to help my family do it, I had to scale that learning curve. So my hope in some of these videos is that I can share some of my experience and maybe shorten your own learning curve. I don't warrant that all of the information is entirely accurate. It is my good faith effort to present you with accurate information, but feel free to drop a comment in the box below if you think I've missed something. I invite you to check out the website that I have associated, and please check back for additional content, and I appreciate you being with me today. Thank you.